Banking is one of the major segments or sectors in the Indian markets, and it's the largest segment by weight on your major indices such as Nifty and Sensex. Some of the largest companies in India are banks like your HDFC Bank, ICICI Bank, SBI, etc. In terms of market capitalization, the largest companies that we look at. And so it's obviously imperative that these form an integral part of every fund portfolio and every investor's portfolio. It's important to understand how do you go about valuing banks purely because there are a lot of nuances to the specific sector that banking is or non-banking financial companies are, that you cannot go ahead and deploy most of your standard valuation or statement analysis methods to a bank, right? The idea there is to basically then figure out what is it that causes these differences when you're evaluating a banking sector versus some of the other sectors. And how do you basically then go about evaluating a bank if you were to, and why are certain ratios more important for a bank than the other ratios that are there? So in that context, we're going to kind of cover a few topics here. We're going to cover what is different in valuation of a bank. Why would conventional methods of valuation, typically known as discounted cash flow models, right? We know about DCF models. Why don't they work? What kind of methods work in terms of relative valuations, and why do they work when some of the other things do not? And any other numbers and metrics as an example. So over the course of the next 30 to 35 minutes, we're going to discuss this. Very quick recap of how does a bank work, right? So a bank basically accepts deposits, and once it accepts deposits, it essentially also has to put in some part of its own equity. And usually the ratio of its own equity to deposits is as skewed as what you see here. So equity is about 10 and deposits are about 100. Deposit, remember, is debt for a bank effectively, right? So you have debt and you have equity, and that gets pulled in. Once that gets pulled in, then you have to put some amount out as reserves, regulatorily speaking. So there is a regulatory issue around this thing. These reserves are either things like CRR, which is cash reserve ratio, or SLR, which is statutory liquidity ratio. Combined, roughly about 25% of your deposit base goes into these, approximately. And the remaining amounts can be loaned out, right? So that's how it works. The banks basically make their earnings on this portion, and this portion is going to be their biggest expenses. The interest that they pay out to the depositors is going to be their biggest expense, right? This is where regulation comes in. So regulation is an important part of the banking sector, and this is where equity comes in, or the promoters would put in the money in the bank, correct? That's the broader contour of how a bank would work. Let's now extend our understanding on how is banking valuation different. So what makes the banking valuation different from any other sector? Point one is that it is highly regulated. Financial services firms are typically extremely highly regulated by the central bank. In India's case, the RBI would regulate them. A firm's value depends on the amount it could reinvest. While for banks, this reinvestment is always subject to scrutiny of the regulator, which is your RBI, right? Think about it this way, that if you were to if the regulator were to kind of increase these reserve requirements, then the bank's growing ability goes down. So a lot of the ability of the bank to basically grow or increase its business or do some sort of a reinvestment into the business depends on regulator scrutiny. A bank can't randomly go and open branches. The opening of the number of branches depends on what kind of licenses are given and how many branches could be opened during a particular year. So theoretically speaking, the regulator kind of controls a lot of the growth opportunity in the bank, and reinvestment, which results in terms of growth coming in, is highly controlled by the regulator, which is RBI in this case. So you can't directly make an assumption that a bank making so much money will be able to open so many branches and would be able to grow its business by that much, because there is a regulation in between that might stop it. The next part that is important about banking is the accounting policy around banks. When you look at the accounting policies that come in, the accounting policies in banks ensure that the assets and liabilities for a bank are financial in nature. And hence, all these get marked to market. Your entire balance sheet, right? On your balance sheet, you will see that in general, the way accounting works is the balance sheet carries values at cost or historical value, right? Unless the fair market value is substantially different, and we follow what is called as principle of conservatism in that. However, for a bank, because balance sheet is made of all assets and liabilities which are largely financial in nature, they end up getting what is called as mark to market. The moment you mark to market these numbers, they become recent. And unlike any other business where these assets and liabilities could be financial, could be historical in nature, in the banking segment, they're extremely recent. Right, so that becomes one of the major differences in this, and we'll see how that gets used in certain kind of ratios when we compare banks versus some of the other segments. The earnings itself, the way you calculate profits of a bank, so the bank's financial statement looks something like this. You will have what is called as interest income, from which you will subtract what is called as interest expense, and then you will get what is called as net interest income. You will get some other income, which could be, all the income that banks charge on, the sort of withdrawals that you do from ATMs, or other income that could be made on investments that a bank has done, or investment banking income, or any other income that bank makes is other income. You add these two, you get total income, from which you will subtract all the operating expenses. And then before you go to the point where you pay taxes, you also subtract something called as provisions. Now, what this does is, after subtracting these provisions, you come to your net profit number. These provisions are supposed to be created for likely losses while you are making the lending, right? NPA, non-performing assets that get created, you have to make a provision to ensure that the numbers, in case you make a loss at any point of time, rather than taking that hit in that particular year, you would make that provision across multiple quarters. Regulatorily, you are supposed to do that. What that does is it distorts your profit each quarter lower, and that essentially doesn't give you an exact nature of the profit that the bank is making. So that's one other issue that comes up in terms of the accounting policies that are there in the banking segment. The next issue that you face in banks is a very critical issue, which is, unlike other sectors where debt is capital, for a bank, the deposits or debt is raw material. Now, in this context, you have a basic tenet of finance that gets kind of complex here. And the idea is, the conventional definition of debt does not work here. A debt equity of something like 10, which we have in banking, would be frowned upon in any other business, but that's a business as usual in banking system. In fact, if you leverage it enough, the debt equity number could actually go to something like 20 in a lot of the countries. And so by definition, banks are over leveraged, and your conventional thought processes around how do you go and evaluate the financial statements of a bank are very different from how would you evaluate, let's say, an infrastructure firm or a metals firm, where higher debt could create a lot of problems. The integral part to our understanding is that debt is raw material, unlike a capital source for banks, right? It's a straight stuff that you're going to get in terms of deposits, and you're going to lend it out again, correct? So it makes things a little bit unconventional for banks when you look at them in that context. That brings us to the final point, which is what makes banks very intriguing, is how do you estimate a cash flow, right? Now, suppose you have a conventional understanding. The NPV analysis that we do is essentially cash flow 1 and cash flow 2 and so on and so forth. And each cash flow is basically discounted by a certain rate, which is going to give me the net present value. And that's basically, the broad tenet under discounted cash flow valuations, right? How do you make a cash flow? So if you were to use the indirect formula of making a cash flow, you start with net profit, and you start with adding depreciation to this. And then there are a few line items that come here, right? So you subtract any change in net working capital. Then you subtract any capital expenditure or Capex, and you subtract or add any changes in debt. Correct? These are some of the integral line items that would come when you would create a financial cash flow statement for any company, right? Let's take them one by one. Change in debt. For a bank, most of the cash inflow and outflow will be debt. So this change in debt is going to significantly overpower your overall cash flow statement. The other numbers would appear minuscule as compared to these change in debt numbers. So that doesn't, create a correct scene when you look at the cash flow statement. It just appears extremely odd or, different from some of the other sectors that you would find. The second thing is, what is Capex for a bank? Most of the Capex for a bank would be stuff around technology or human resources. And that is not really treated as Capex. Most of the companies would end up treating that as an operating expense. It gets expensed out. It doesn't get kind of accounted for as a capital expenditure. And so that creates a second problem. And the third problem is working capital. Right? What do you define as working capital? So working capital is basically current assets minus current liabilities as per the conventional definition. And current assets would be receivables. So what would be receivables for a bank? What would be payables? There's no inventory, right? So technically, a lot of these concepts, which is net working capital, Capex, change in debt, do not work. Conventional cash flow statements do not make any sense when you try and do a discounted cash flow valuation. So inherently, a standard cash flow measure, which is used in any kind of NPV analysis, cannot be used. It falls flat. Three reasons. One, most of the cash outflow and inflow is debt. That distorts the overall structure of the cash flow. Two, most of the Capex tends to be stuff which is treated in the markets as OPEX. Three, any kind of working capital assumptions cannot be made here because of the fact that there's no concept of a receivable or a payable or inventory in its conventional context. So that makes another set of challenges in terms of creating a cash flow statement. If you can't make a cash flow statement, you can obviously not go ahead and do a DCF valuation. In fact, calculation of the rate itself will create a problem because the moment you try and calculate WACC and you try and use the debt to equity ratio in the context of the WACC, that is a distorted number for the banking segment. So it tends to create a lot of trouble if you try to do DCF valuations and combine all these things together. The problems of valuation in banking, the way it is treated and the reason it is different is it's highly regulated. All kind of reinvestment is subject to regulator scrutiny. Accounting policies ensure that all assets and liabilities are financial in nature, unlike other sectors where the balance sheet carries assets at historical cost a lot of the times. Debt, the treatment of debt here is very different. Debt or deposits are raw material, unlike source of capital for other businesses. You can't substitute debt to equity in this business, essentially. Right, you have to use that deposit to be able to run this business. This banks by definition are over leveraged and a debt to equity is nearly 10 for a banking system. In general, that's business as usual. And estimation of cash flows is a problem because standard cash flow measures would adjust for movements of cash inflow and outflow around debt. Most of these are debt for the bank. All your Capex tends to be classified for a bank as operating expenses. And the final problem is with working capital. We don't know how to classify things like receivables or payables or inventory for a bank. There are no such numbers that are there. Correct. So to that extent, these numbers become tricky, and so consequently, one of the broader methods, which is the discounted cash flow valuation method, can't be applied properly in the banking system. There are some changes you could do to that to try and apply that. Let's see if that works. So what are the solutions available with us? Let's move to the solutions now. Clearly, DCF is a problem. Can we use what is called as dividend discount model? When you buy the stock of a company, the actual cash flow in your hands is only the dividend. So that's one step before your discounted cash flow valuations, where you use what is called as free cash flow to firm or free cash flow to equity. Here, you're going one step back and using dividend. Can you use DDM? Now, there are two challenges in using dividend discount model in a market like India, right? The first one is India is an emerging market. So in dividend discount model, you assume that in steady state, bulk of your earnings are being given out as dividend. You invest or reinvest only a very small amount. Typically, steady state would assume that your dividend payout ratio, right? Your payout is north of 80%. Now, in India's context, you wouldn't find too many companies that actually do that. In fact, there are a handful of companies that would actually be at that stage that they give out 80% of their profits as dividend. That only happens when companies lose or are not able to find out enough opportunities for growth. And that's not true in India. So most of the banks actually don't even give dividends or give very little amounts of dividends. Consequently, if dividend is zero, does that mean the value of the company is zero? Right? So if that is not the case, then you can't value it using DDM. You can also assume something else, which is, there are some ideas that you could change, assume that earnings equal to cash flow, right? So your net profit is equal to cash flow since there is very little capex that is happening, and you're saying that technically speaking, most of the capex that is there is kind of opex and anyway treated for. And you don't have receivables or payables, so there wouldn't be substantial changes in working capital any which ways. So you could treat earnings as cash flow. The problem is if the entire earning, 100% of earning is given out as cash flow to the equity holder, right? Then you can't reinvest, right? So your reinvestment is equal to zero. If reinvestment is equal to zero, then your reserves, right, reserves and surplus will become constant because that's where your undistributed profits go and sit. If your reserves and surplus becomes constant, the bank's equity, which is the book value of the bank, becomes constant. And if the equity is constant, the bank can't grow. To increase the lending, the bank will have to increase its book value, right? Book value is basically reserves and surplus, retained earnings, or the equity value. And unless you can do that, the bank cannot grow. So if a bank chooses to give 100% of its profit out as dividend, it anyway cannot grow. And so when you say that earnings are the same as cash flow, if I make that assumption to try and simplify the valuation of a bank, inherently I am using a flawed premise that the bank cannot grow. And if it cannot grow, then what's the point of valuing it? It's going to have a steady annuity that's going to come in. You can value it as an annuity. That's not very reflective of the actual market condition. So it's important for us to understand that DDM also does not work. Dividend discount model is also a futile model to apply in the context of most of the banks, especially in emerging markets like India, primarily because in emerging markets, the growth tends to be significantly high. And so you will not find too much of a scenario where banks would be giving large amounts of dividend and reinvesting very small amounts. That doesn't happen. Banks end up reinvesting most of their dividends into their equity and profits into their equity so that they can grow the business further. Correct? That creates a problem with the dividend discount model as well. Which then brings us to the next point, which is what comes to our rescue. How do you evaluate using relative valuations? Now, relative valuation is basically a method of valuation when you're looking at the valuation of multiple companies in the same sector. It comes with its own set of issues and benefits. Issues are primarily that you're assuming that the valuation on a broader level is correct, right? The market valuation is correct, and you're just looking for a relative undervaluation or overvaluation, right? Undervaluation or overvaluation. Relatively speaking, you're comparing companies around that, right? So that's a premise that may or may not go down well with a lot of the purists in terms of valuation. It is going to require another company to value your company. Whereas something like a discounted cash flow model is an absolute valuation model. You can just value the company in isolation, right? Now, the good part about relative valuation is sometimes, like in the banking segment, you don't have clear-cut measures of what is going to be the cash flow. So it's much simpler to actually value it using relative valuations, compare it to other similar entities, and smoothen out any differences that are there. Right? Now, what metric do you use? Typically, there are four kinds of broader ratios that come across segments. price to earnings, price to book, price to sales, enterprise value to EBITDA, right? Let's understand this. The first one, which is PE ratio as it is commonly known as, gets distorted because your E, which is the earnings or earnings per share in this context, gets distorted. Why does it get distorted? It gets distorted because of provisions. You're making provisions for loan losses. So in certain years, there's a regulatory requirement. Let's say this is the regulatory requirement. In certain quarters, the bank could go significantly above the regulatory requirement. And because it has done that, in the next quarter, it could be lower than the regulatory requirement. Now, when you start doing this kind of an adjustment on a quarter to quarter basis, earnings tend to become chunky and they tend to become volatile. You can't directly go and say PE of one bank is comparable to PE of another bank, because it's quite possible that one bank has done lots of provisions, right? Lots of provisions would mean safe bank. Safe bank would mean less net profit, and less net profit would mean high price to earnings. And under the conventional definition of price to earnings, you will not buy it. So effectively, PE gets distorted for banking because earnings essentially are subject to provision requirements, and provision requirements leave a little bit of adjustment for the bank as to what do they consider as what would you say, what do you consider as NPA, and then how much do you provide for that NPA. That becomes a very, very critical portion of this entire discussion, right? So price to earnings becomes a problem. You can't use that. Price to sales is also a problem because how do you define sales, right? So price to sales is also is known as market cap divided by total sales. What is sales for a bank? Is it the amount of loans you have given? Is it the amount of interest earned? Is it the amount of net interest income, which is interest earned minus interest deducted? Is it net interest income plus other income, right? Now, theoretically, you can use any one measure, but this confusion around what do you classify exactly as sales is what creates a bigger chunk of problem around this entire exercise. So most of the times you don't use price to sales as well. There is no concept of EBITDA for a bank. I mean, technically, EBITDA is earnings before interest, tax, depreciation, and amortization. And you can't have earnings before interest for a bank. That doesn't make sense. So because there is no EBITDA for a bank, you can't use enterprise value to EBITDA for a bank either. So that basically leaves us with one, which is price to book. Right now, price to book is an intriguing measure. It tends to get distorted for a lot of the other businesses purely because the book value that you see, this book, is historical in nature for a lot of the companies. So what do you define as book? If you look at a company's business, what you're saying is that effectively your reserves and surplus or shareholders equity plus reserves and surplus, which is nothing but your total assets minus external liabilities, is what is going to be your book value. Correct? So this is your book value. In other words, what you are saying is that whatever unearned profit, whatever undistributed profits are there, right? Profits that have not been distributed as dividend keep getting added into the book value. You keep doing that over year, each year, till the time you arrive at whatever the number is today, right? So it has to include share capital, shareholders equity, plus reserves and surplus, or retained earnings as it is called in certain definitions, right? You add both of that, that is the book value. Now, the problem with that in most of the industries is when you look at this definition of assets, correct? This asset could include a factory. Now, the factory is being carried at cost in most of the cases. And let's say there are two companies, A and B, one which started business in 1990, another which started business in 2010. They might have the same amount of capacity. They might have the exact same amount of sales and earnings, but their asset values could be completely different because their carrying values are different in the markets, right? And so essentially, whatever you have put on the balance sheet in terms of book value could get severely distorted depending on what is the value of your book in that context. That doesn't exist as a problem with banking. Why? Because all these assets and all these liabilities are financial in nature. because they are financial in nature, this distortion, which happens because of comparison of companies with assets across tenure, that is not a problem in banking. Each bank's assets and liabilities are marked to market on a daily basis, practically, right? So when you are comparing the banks, there is no question of a mismatch in terms of the age of the assets or value of the assets in terms of time, right? So that makes one of the best metrics in terms of banking for book value to become important. The other reason why price to book becomes important is because this book value of equity is your equity capital, which is what is going to drive the growth. So a bank which has a lot of equity capital available with itself is likely to grow faster. A bank which adds quickly to its equity capital because of substantial profit making ability can grow faster. On the contrary, a bank that does not add to its equity capital, is making losses, cannot grow. And that's basically the definition between, a PSU bank in India or a private bank in India, the difference between these two. PSU banks end up making losses, so their equity kind of gets restricted unless the government does something like a recapitalization plan, which is where the government goes and pumps in equity into these banks. They can't grow, right? Because they're not making profits. Private banks, on the other hand, keep growing because they keep making profits. Because they keep making profits, their reserves and surplus keeps going up. Because of that, the book value keeps going up. Because of that, equity is higher. If equity is higher, you can lend more because of capital adequacy ratios. Correct? So effectively, book becomes a very, very important indicator of growth for a bank. It's again sort of a raw material for a bank, if you could say that. So you are trying to compare what is the value the market is giving to the bank on the basis of its book value of equity that is available. You can calculate price to book using market cap of the bank, market capitalization of the bank, divided by total book value of the bank, and that would give you this measure. And that becomes one of the most integral parts of how do you go and value banks, which is why anytime you see a report of a banking sector, you will see the only measure that gets discussed is price to book value. And that's your primary indicator of banking valuation that you're going to use in the context of high growth sectors, high growth countries like India. If it is a slower growth kind of a country, you could still use what is called as dividend discount model. But if it is an emerging market, you don't have an option but to use price to book value. You cannot use any other metric regardless of where the markets are headed, right? Now, how do you basically look at price to book is where you start comparing various banks. So we've just taken a broad list of 4 or 5 banks, 3 of them private, ICICI, HDFC, and Yes Bank, and we have SBI and PNB. Right, there are some numbers that you will see, and you will see what is the market cap. All these numbers are in INR crore, so an approximate. They have been rounded down to the nearest thousand. So ICICI's market cap is about 2 lakh crore. HDFC is the largest bank. It's about 5 lakh crore almost in terms of market cap. SBI is 2.67. Yes Bank is 74,000. PNB is 42,000 crore, right? Then you have a book value which is available. You can actually just calculate price to book by A divided by B. A divided by B is going to give you the price to book ratio of each of these banks. We'll calculate that and check as to what those numbers look like. Then you have given things like what are the total assets of the bank, what are net profit of the bank, non-performing assets, how many of these loans that the bank has given out are not going to come back, approximate number, net interest income, which is basically interest earned minus interest paid on the deposit. So who's making the highest amount of net interest income? What are the loans given? These are the lending numbers of the bank. So you have to compare the NPA to the loans given effectively. Then you have deposits, which is what is the amount of money raised in the form of deposits from the depositors. You have something called as other income, which is essentially your entire fee-based income model, right? And other income as a percentage of total income. You do see that private banks have a bigger component of other income as a percentage of total income. And that's because of the franchisees that they hold, the kind of products that they sell. They are very big in investment banking. They are big in brokerage. They are big in a lot of the other cross-selling of other products which are there. And that adds up into their revenues. essentially. PSU banks are not that great here purely because of the fact that they don't do all these other services that are available. Then you have a term called CASA, which is nothing but current and savings accounts. And you use this term specifically for the banking system because this is like your low cost deposits, right? So a bank has to raise deposits, and current accounts have 0% interest rate, savings account have 3 to 4% interest rate. A bank that has a bigger chunk of CASA is going to get a better margin because they've raised money at a lower cost, right? So that becomes a very, very integral part of your discussion in terms of your overall consideration of a bank, right? Now, where does that leave us? You can basically calculate some of the ratios right away. So if you were to calculate the price to book ratio using this data that is there, this is what you are likely to see, right? And you see the price to book ratio of various banks, and you look at the data around these, and you see there is a wide divergence. You are starting somewhere from 1.24 going all the way up to 5. Now just step back a little bit and understand what is price to book value. If you are standing in 2018 somewhere here, then book value of a company is basically all that the company has done in the history. You can't change that. This is profits that the company has already generated, right? So if the company's book value is, let's say, 1000 crore and the market cap is technically speaking 700 crore, there is an arbitrage available. You can buy the entire company at 700 crore, sell all the assets, repay all the liabilities, you should be left with 1000 crore. So if your price or market capitalization is lesser than the book value, theoretically speaking, this is an undervaluation. You should be able to purchase this company and close it off. That, however, does not mean that that's always available, right? PNB used to trade at a price to book of less than 1, but you can't buy PNB completely because PNB is owned by the government, which basically means that your market cap is a combination of your history and what you expect to do in the future, right? So when you say market cap to book is higher for a bank like Yes Bank or a HDFC Bank, you think the future is much better than what history was, right? And when you say market cap to book is 1.24, then you say that bulk of the value in this company is coming because of what it has done already. You're not so sure about the future, right? And that's a way of defining things. Essentially, companies which are trading at higher market cap to book value ratio, you are more certain about them existing in the future. You're more certain that they are going to be existent in the future 5 years, 7 years, 10 years, 15 years down the line. And that's an example of HDFC Bank here. You're not certain if PNB will continue to make profits because it is politically owned, and it keeps giving large amount of bad loans. If you actually were to compare stuff, for example, NPAs that it has, look at the size and scale of a few of these banks. Look at the amount of loans that a PNB has given versus loans that an ICICI bank has given. That's not too different, right? But look at the net non-performing assets, right? The non-performing assets on a gross basis are about 2.5 times that for PNB versus ICICI Bank. And ICICI Bank isn't even one of the better ones in that context. You see much lower non-performing assets for HDFC on a bigger number of loans given. So consequently, you're not so sure of a PSU bank, and that's why you're valuing it lesser on a price to book basis. Now, always remember that you chunk them around. You compare PSU banks to PSU banks, and you would compare private banks to private banks. That's a rule of thumb that you have to remember, that you have to chunk the similar looking sets together, right? Let's comprehend these ratios a little bit more. If you look at these ratios a little bit more, you could calculate a few more ratios, right? And then try and correlate. So we've calculated return on equity, we've calculated return on assets. Return on assets is a commonly calculated number that is there for banks. Banks that are anything above 1, return on asset greater than 1%, is considered good globally, right? Less than that is usually not, considered good. Return on equity, you will see again that the valuation is highly correlated to what kind of return ratios you carry. HDFC Bank carries a significantly higher valuation because return ratios are better. Yes Bank carries a significant higher valuation because return ratios are better. NPAs are much lesser for HDFC Bank. Comparing the size of HDFC Bank to a Yes Bank, it's still a much safer bank. CASA ratio is much higher, which means they have a bigger access to lower cost deposits, right? Now, remember that this CASA ratio that we look at is a little bit higher than average. The average CASA ratio is lower by about 5 to 10 percentage points. This entire chunk is appearing significantly higher because of demonetization last year, right? If demonetization had not happened, you would have seen CASA ratios at a lower number for most of these banks. Somewhere around 40% is the broad average that is there. This has spiked up last year because of this entire scenario. But there's a straight correlation. You'll again see that banks which have a bigger spread or branch network are likely to have a bigger CASA ratio. And so consequently, they're likely to be valued more. Uh, ICICI loses out on the NPA front. In fact, ICICI's NPAs are in similar sense closer to an SBI. So ICICI is actually more like a PSU bank than in terms of the way its NPAs are stacked up than let's say a private bank. And that's why the valuation is much more closer to an SBI and not necessarily closer to an HDFC bank in that context, right? So that's the way you would sit and correlate these numbers and say where it goes. It doesn't end there because we have not yet defined whether we should buy any of these banks or not buy any of these banks, right? In terms of broader definitions, this would tell us that in private banks, we should be buying ICICI Bank and Yes Bank, and in PSU banks, we should be buying PNB. But remember, when you're looking at a bank, a risky bank is more or less over a period of time equal to a bad bank. It is going to create a problem. Banking is not a sector where risk taking is essentially rewarded. Risk taking is uh, going to get a problem in terms of at some point of time it's going to create a substantial problem for the banking segment, and you don't want that to happen. So banks get a significant premium for their asset quality. A bank that has a good asset quality is always going to get a significant premium purely because you believe that it will exist in the future. Whatever goes wrong, this bank will not shut its operations down. That's not so true with some of the other banks, right? Relatively speaking, in India, you do believe that you'll not see any bank shut down. But that doesn't mean that, relatively speaking, the probability of uh, PNB closing versus HDFC closing is the same. That is not. PNB could continue to make a lot of losses. It cannot survive without government issuing recapitalization bonds or getting into some sort of equity issuance with PNB. Otherwise, these banks have not been growing. That's precisely why the entire recapitalization announcement had such a positive impact on the PSU segment. Private banks don't need that, right? So that's one part of the story. The second part of the story is when you look at banking sector, it is essentially an integral sector to the economy. So if the economy continues to grow, banking has to grow, right? And when you look at that, even HDFC might be a good buy depending on what is your time horizon, right? To gauge that, let's compare something like a Wells Fargo. So we just add Wells Fargo to the list. Look at the price to book for Wells Fargo. The market cap of Wells Fargo is about 4 times that of HDFC Bank, about 10 times that of ICICI Bank, right? Even 8 times that of SBI, roughly. Book value is about 10 times of ICICI Bank and 11 times of HDFC Bank. Assets are significantly higher. If you look at the assets, assets are 15 times HDFC Bank, right? Obviously, you don't see the net profit 15 times. HDFC Bank makes a lot more profit on its assets than what a Wells Fargo does. And that probably explains part of the reason why this valuation exists. So it doesn't tell you that HDFC is overvalued. Relatively speaking, yes, but there's a reason for that overvaluation that exists. Is that if you actually were to compare what kind of profit you derive on the assets, which is a return on assets number, the return on asset for HDFC Bank is nearly 2.5 times that of Wells Fargo. If HDFC reaches that kind of asset number, it's going to generate 2.5 times profit of what Wells Fargo does, and so consequently the valuation could be much higher, right? Now just keep in mind that Wells Fargo is the largest US bank. US economy is roughly 8 times India's economy size in absolute terms, GDP, correct? So you would expect that as Indian economy continues to grow over the next 8-10 years, some of these banks will garner substantial chunk of growth, and that is going to be a very, very big fillip to their numbers. That doesn't mean you buy them right now, but if you have a horizon of 8 to 10 years, then maybe this is not overvalued, because you are looking at the assets of this bank or the loans that the bank has given. HDFC has 5 lakh crore given. Wells Fargo has 61 lakh crore given, 12 times, right? So the loans, the deposits, the just sheer size of what HDFC is versus what Wells Fargo is, there could be a substantial up move in the times to come. So if your time horizon is long, you go for the safer banks, right? In itself, price to book value may not mean too much. It kind of assumes the bank that is going to stick is going to do well. HDFC, by the way, continues to grow at about 20% each year. So it doubles itself roughly in about 3.5 to 4 years. Every 4 years, it kind of makes its size twice, right? Yes Bank, take a look at, if we were to just take this comparison across two more banks, let's say we were to look at Yes Bank and we were to look at PNB, right? Look at the asset size of Yes Bank and look at the asset size of PNB. Now, there are two derivations out of this exercise. Yes Bank might, the rate at which it is growing, which is somewhere about 20-25% at this point of time. If it grows at 17-18%, it's going to take about 6-7 years to reach that asset size. And when it reaches that asset size, note that for the same amount of assets, they are generating significantly better net profit. Their net profit is nearly 2.5 times at 1/3 the asset size. And that's because NPAs are much lower. NPAs for PNB are nearly 27 times higher. And so consequently, their valuation is better. But if they grow to a 7 lakh crore kind of an asset, their valuation could move towards what ICICI's valuation is, right? Because that's where ICICI's assets are. And so effectively, you are saying that the stock could become 3 times in a period of close to about 6-7 years, and maybe more, maybe earlier, or it could probably rise more because its asset quality is far better than what an ICICI bank has, right? Its return on equity and return on assets is better than what ICICI Bank has. So it's quite likely that it might actually continue to keep its overvaluation vis-a-vis ICICI Bank, right? It's important to look at all these metrics and then make a case for what is the price to book value. Usually you will find that price to book for PSU banks in India is going to move between somewhere around, on a fair value basis, between 1 to 1.75, and that's a range in which that trades. And that for private banks in India is going to move between 2 to 5, where 5 is the likes of HDFC Bank, 2 to 3 is the likes of ICICI, Axis Bank, etc., and 3 to 4 is the likelihood of smaller private banks, your Yes Bank, RBL, etc., that play out. And that's the historical range that has been. If it changes this range, that gives you an opportunity. So about a year back, PSU banks on average were trading at 0.5 to 0.6. If you believed that the government was going to do something about it, there was a straight 100% available to get there. PNB's current stock price is 176. Roughly about a year and a half back, this was probably trading at close to 100, right? And so there was a straight amount of money that was available on the table if you could look at this band broadly and play around this band. The important part is two things. One, you have to understand that valuation is not as conventional and straightforward as what you would think would be the case in any other sector. And it's not so easy to make a case for a black and white kind of a valuation here, because it depends on a variety of things. If you're a long-term investor, try and ascertain why does a bank get that valuation which other banks do not. And that's your primary premise where banks would get that valuation from. What are the numbers that are causing that valuation, right? You could also calculate some other metrics from this. You could just take the market cap and take a ratio of the market cap to net interest income that a bank is generating. You can take a ratio of market cap to the assets that a bank has had. A lot of the banks in India are going to significantly increase the other income portion of their total. Look at Wells Fargo, that's at 45%. Some of these banks are going to start generating a lot of that as well. And that is where I think the story lies in the banking system. It's about the fact that there will be a significant financialization, and some banks will do better than the others. Always remember, if you're a long-term investor, safety in the banking segment is your primary concern that you're going to look at, right? And based on that, you're going to decide. Even if safety means you are overpaying for a bank, that is fine, because the likelihood of that bank surviving a downturn is substantially higher than any other bank that exists on the spectrum. And that's precisely how you would go about evaluating banks. That's it in this particular session.